Hello. With all the attention on corporate bonds recently, I wanted to highlight the single most interesting bond in America today, and that's the OPI 4.5% coupon maturing on February 1st, 2025. What makes it interesting? To start, it yields 32% as of the market close on Friday, May 3rd. And while that would often rightly be associated with a company that's about to go under, let's take a look at their first quarter results announced on May 1st and one technical market indicator. Rental income was $7 million higher this first quarter than a year ago, but interest expenses were $10 million higher, so they had a $5 million net loss versus flat last year. Their equity capital base shrank by that amount to $1.25 billion, hardly a fatal blow. In fact, as of March 31st, the company had $3.4 billion of net real estate properties and $731 million of secured debt. Assuming a loan-to-value of 70%, that would imply $1.05 billion has been secured, leaving $1.5 billion unencumbered against $1.85 billion of unsecured debt. Along with earnings, the company announced that unsecured bondholders can switch into new bonds that would be secured by $722 million of first liens and another $1 billion of second liens. One of two things can happen. Either unsecured bonds convert to secured bonds, meaning less unencumbered collateral, but also less unsecured debt to pay out of that. Or unsecured bonds will choose not to exchange and the balance sheet will remain as it is, which would imply a recovery of 59% on unsecured debt after a 30% haircut on property value in a liquidation. Additionally, the company said they have $159 million of available liquidity, mostly from a bank credit facility. That's the fundamental picture, including what's potentially available to secured and unsecured creditors in a bankruptcy. Now let's take a look at our market technical, which results from a process called acceleration, in which bankruptcy claims are crystallized to enable the settlement of the issuer's estate. Silicon Valley Bank is a great example where the shortest of their 5 senior unsecured bonds, originally due 8 months from now with a 3.5% coupon, trades at a dollar price of 67, making the yield coincidentally 67%. The longest bond, maturing nearly 7 years from now, has a current price of 64, making that yield 9%, so the 6-month bond yields 58% more than the 6.8 year. Now let's take a look at the OPI Feb 25 and their second most actively traded issue, the 2.4 of Feb 1, 2027. The longer bond's yield is lower by 1.5%, and that difference shrinks to 1% when you take out the US Treasury yield curve and look only at the credit spread. In prices, however, the Feb 25 is trading at 83, the 27's at 50, and a 33-point difference does not look like the market expects an imminent bankruptcy. Keep in mind, these are actively traded bonds, with the Feb 25 averaging 44 trades daily, the 27's 18 trades per day on average over the last 2 months. With the 25's maturing in 9 months, every day the price doesn't change, the yield gets pushed up by 0.1% or 1% every 10 days. The market will need to make a decision soon. OPI's management announced just this year that they were restarting their dividend in what appeared to be a genuine good faith gesture. They clearly want to retain control of their business and its $4 billion of assets, which they will not if they don't repay every dollar of their unsecured bond due in 9 months. The OPI 4.5s of February 25 will either be a big I told you so and a cautionary tale for the ages, or a bond home run for investors buying it at a 32% yield. When it comes to bond maturities, Stay short, my friends.